The long-awaited reports have arrived. What did Warren Buffett, George Soros, Ray Dalio, or Cathie Wood invest in the last quarter of 2025 when stock markets hit all-time highs and Bitcoin started its decline? In today's video, we are going to find it out. I'm Dalio, the founder of Investor Edge Academy, and if you want to see more videos like this, subscribe to the channel and hit that like button. The 13 F forms have arrived again. These are the mandatory reports for asset managers and investment firms managing over $100 million. They must disclose how their portfolios have changed within 45 days after the end of each quarter. This time, the report covers the period between the 1st of October and the 31st of December, so the last quarter of 2025. Let me know in comments what your biggest position was during this period. I think this will make the rest of the video even more exciting. Let's start with the Berkshire Hathaway portfolio. So the last ever changes Warren Buffett made, because as you probably know, he has retired at the end of 2025. So from now on, his protege, Greg Aber, is leading the company. I think there are three major things that we need to talk about when talking about Berkshire Hathaway's portfolio changes. The first one is the positions that they bought. Actually, there's one new position that they acquired. The positions that they are trimming, so they are selling off parts of the portfolio. And the third one is actually probably one of the most interesting parts, is what do I think if Berkshire Hathaway will be able to outperform the market just as they did in the last 40, 50 years. Now, let's start with the positions that they streamed. As you probably guessed it already, they are still selling off Apple shares and Bank of America shares. If you're looking back 2 years, you can see that they own more than 5%, actually a little bit more than 5.5% of total Apple, the company Apple. Since then, they were slowly, sometimes a little bit more aggressively, reducing the positions, and currently they only own 1.5% of the total company, and they also decreased their portfolio, the total portfolio, from almost 50% of Berkshire Hathaway's total portfolio. Now Apple is only taking up 22% of their portfolio. It's the same with Bank of America. They've been reducing and trimming those shares for quite a while. And there are some minor changes as well in other companies. There's one notable mention which was highlighted in a few news outlets, which is that they sold almost all of their Amazon shares. They actually decreased it by 77% of the total Amazon shares that they owned. Maybe they are thinking that Amazon is now a little bit overvalued or fairly valued, so this is why they are trimming and decreasing their positions. That is one option that we need to talk about. Now, there's also some positions that they are buying. They are either increasing the shares, or there's one position and one company that they acquired new shares in. Let's start with the ones that they increased their shares. Warren Buffett also increased Berkshire's stakes in oil producer Chevron and insurance firms Chubb Limited. I think these are the two notable mentions. If you haven't heard about Chubb Limited, they are a massive insurance business. If you ever bought, let's say, glasses, or if you ever bought a phone in Europe, there's very likely that the insurance behind that is Chubb Limited, because they do these types of insurances, but they also do big business insurances. So wind turbines, airports, complete airports, airfields, and different types of reinsurances as well. And there's one company that we definitely need to talk about, the new addition to their portfolio, which is New York Times. Now, I'm guessing that you've already know and heard about New York Times. Probably you are a reader of New York Times, but I think there's a tiny bit of things that you need to understand about this company and why Berkshire Hathaway thinks that they could be a great asset to their total portfolio. If you look at New York Times, you will see that you need to log in to read their news, and you need to have a subscription. Now, obviously, subscription models have moved away from paper subscription models to digital subscription models, and that's what you can see from their earnings. So they got three major pillars of revenue sources and revenue recognition. The major one, the most important one, is digital subscriptions and total subscriptions. So they've got almost 13 million subscriptions, and 12.2 of them are digital only ones, and only about 600,000 members are the old-fashioned ones that they do read printed outlets. And if you look at the revenue recognition from those subscribers, you will see that it's about $500 million every quarter. And if you look at the advertising revenue, it's about 200-ish million. So you can see that the major pillar of their revenue recognition is actually subscribers. So this is their core business and their core motor and engine of revenue. About 200 million is advertising, and they also get about 100 million with affiliate and licensing products. So they've got a really strong core business and core audience that they can rely on, because they will pay the subscriptions every single month or every single year. So this is why I think Warren Buffett thinks that this company could be a great addition to Berkshire Hathaway's portfolio, because this is going to be a stable anchor for their portfolio. And I think there's one more thing that we need to mention, which is if you're looking in relation to if Berkshire Hathaway will be able to outperform the market as they did in the last couple of years. You can say it's not a couple of years, because if it's 40 or 50 years, it's more than a couple of years. However, if you look at the last year, Berkshire Hathaway massively underperformed the S&P 500. If you look at the last 3 years, now due to the last year, it started to deviate from the S&P 500 returns. However, if you look at 5 years or 10 years, you can see that Berkshire Hathaway outperformed the S&P 500. The big question is if they will be able to outperform the market in the next 3, 5, or 10 years, because what you are going to decide if you want to invest some money into Berkshire Hathaway. And my contrarian view is that they won't be able to do that. And I can tell you the reasons why I think. I did a little bit of Excel sheet, Google Sheets, of the companies that they sold, the total value of the companies that they sold, and the total value of their new acquired shares. You can see that there's a massive difference, about $5 billion difference. What that means is they are net exiters of the market. Now, if you think about what can you do about $5 billion, that's not a big thing in Berkshire Hathaway's portfolio. However, they are already sitting on more than $300 billion worth of cash. Now, what can they do with $300 billion cash? What they do at the moment is they put it in less than 12-month maturity US government bonds. So short-term government bonds, and they can earn about 3.5%, 4% on those bonds. What that means is that if the S&P 500 earns 10%, on average it earns about, in the last 60 years it earned about 10.5%, they won't be able to replicate that because they are sitting on so much cash. And this cash is actually still adding on. As you can see, they added about $5 billion of cash, which they will obviously invest in short-term US government bonds. So I do think quite strongly that Berkshire Hathaway in the future won't be able to outperform the S&P 500 or even Nasdaq, but Nasdaq wasn't their goal. The main goal was to outperform the S&P 500, and I do think that they won't be able to do that in the next 10 to 15 years. And I'm not saying that it's because of Warren Buffett, because he left the company, because as you probably know, he's no longer the chairman and CEO of Berkshire Hathaway since the 31st of December 2025. And I'm not saying that it's because of Greg Abel doing a worse job than Warren Buffett did. It's just because they are sitting on so much cash that they cannot even put enough cash on the market to be able to outperform the S&P 500. Let's take a look at the changes in the portfolio of Bridgewater Associates founded by Ray Dalio. I was especially curious about this one because in the last quarter they exited from many of their tech stock positions and realized massive profits. So let's see what they did in this quarter. There are definitely some notable things that we need to mention in regards to Bridgewater Associates 13F filings. The first one is that they continued to buy the S&P 500. Actually, this has been the case since the last filings, which was by the 30th of September 2025. And as you can see, they continued to buy S&P 500 ETFs, and they continued this in the last quarter as well, which ended on the 31st of December 2025. These are actually, if you look at this, it is almost a quarter of the whole portfolio that they keep in S&P 500 ETFs. These are literally the same ones, but this one is by State Street and this one is by our shares, but it's the same ETF. It's just two different institutions that have the same ETF. What is interesting is that if you check it, the ones that they bought in the third quarter of 2025, they are sitting in a massive profit. But the ones that they bought in the last quarter, well, they are not really in profit at the moment. We'll see what happens in the next couple of months and in the next couple of years, because as you can imagine, they are not buying these for the next 2 or 3 months. The other notable thing that we definitely have to mention is that the company started to increase some of the shares that they had. One of the most important ones was Oracle. Probably you don't have to, and I don't have to introduce this company to you, but they are one of the largest AI companies in terms of scale and in terms of investments, because what they do is they are investing heavily into AI infrastructure. They've got contracts with OpenAI, with Google, with Amazon, with Microsoft, with all the major AI players as well. And they are about to build billions and billions of dollars of AI infrastructure. And probably the reason why Bridgewater Associates started buying heavily Oracle is because of this massive drop that happened in the last quarter of 2025, because this hype that they were building massive infrastructure projects for AI, this was, I wouldn't say it was a bubble, but I would say that the focus was on they building those ones, and now they just realized that, yeah, it's gonna take some time. So what that actually means is that it will take 2, 3, 4, even 5 years to build that. Plus, on the other side, on the flip side, they are subsidizing these ones by issuing bonds to do all of this and all of these AI projects. The third one that we definitely have to mention is that material costs. Probably you've been looking at markets, you were looking at gold, silver, and all these precious metals. And what you have noticed is that the price of these metals skyrocketed in the last couple of months. For the silver, it was in the last couple of weeks as well. And then it was sort of getting in the 75-ish range per an ounce. And this is what Bridgewater did, because what they did is they started buying Newmont. They increased their share in Newmont. Actually, they really increased their share from 0.13% to 0.85%. So almost 1% of the whole portfolio is now in Newmont. And what you need to know about Newmont is that it is one of the largest gold mining companies in the whole world. They've got operations and they've got mines in North America, South America, and the Asia Pacific as well, especially in Australia. So what Ray Dalio, or actually their portfolio managers, what they are betting on is that gold and silver plus copper prices will continue to increase in the future as well. And in terms of new positions that actually new positions that they open, well, I would say that it's not many new positions. On paper, if you actually check it, it looks like, yeah, there has been a lot of new companies that they bought in the last quarter, but these are tiny bits and pieces. So look at this one. It's 0.00%, which means that it's less than 100% of the whole portfolio, so it's not really worth mentioning. There's actually one company that's worth mentioning, which is, it has a ticker symbol IGV. However, it's actually not a company, it's an ETF. It's a technology ETF. And if you look at the ETF, it is expanded tech software sector ETF, which is now it is 0.1%-ish, 0.11% of the whole total portfolio that they have. So this was the biggest ones that they actually did in the last quarter. And if you look through this ETF, what you can see is that many of the companies they already hold. So for example, Oracle, we talked about that, they already hold it. They actually increased their shares massively. But there are some that are notable and worthwhile mentions. So these are the ones that are in this particular ETF. Next, let's move on to the portfolio of Soros Fund Management. When looking at Soros Fund Management's 13F filings, what you can discover is four things, or I would say 3+1 thing. There's one bet, there's one heavy bet in one sector, and into one company, actually. There's a bet against the whole sector that they are doing, especially in the last quarter. And there are two new companies that I think are worthwhile mentioning. Now, let's start with the first one, the bet, which is in a sector plus in a company as well. The largest holding that they have now is Amazon, is that they are betting big on Amazon, because what you can see is that they increased their position in the third quarter of 2025 from 1% of the whole of the total portfolio up almost until 7%. And they increased it further. Now it looks like that they decreased it, but technically they increased the shares, the number of shares plus the position of the whole structure. But because they open new positions as well, this is why it looks like that the total portfolio, in terms of the total portfolio number, it is declining, but they actually increased the total shares of Amazon. With the last one, so the one that they opened in the third quarter, they are almost in like zero-ish, we can say, we can call it zero, so they are at almost break even. And probably what they saw is after that earnings breakout, and then when the price came down, probably this was the point where they decided, okay, now it's time to double down on Amazon shares. So this is one bet that they are quite heavily into, because if you say 7% of the portfolio is in one share, in these massive big companies, that means billions and billions of dollars altogether. So what that means is that they are betting quite heavily in Amazon and in the tech sector. The sector that they are not really believing in is that you can see quite a few put positions, which means that they are option positions. They are betting that these shares or ETFs will decline and they will make money if those shares and ETFs decline. One of those is XOP, which is a oil and gas exploration and production ETF. And the other one is XLE, which is a energy select sector ETF. Now, if you're not familiar with these ones, these are, if you are looking at S&P 500 energy, this is the select sector energy. These are the companies that are in Exxon, Chevron, ConocoPhillips. These are the biggest oil companies. And if you go down in that list, you can see that many of these companies are heavily into oil and gas. Almost all of them are entirely into oil and gas productions, upstream, downstream, and midstream sections as well. Now, if we are looking at what we know is that they both these ones, or actually they were betting against these ETFs in October, November, and December. At the moment, these ETFs are quite up. So what that means is they are actually sitting in losses. We'll see if they're gonna continue to roll these positions in the first quarter as well. And I think there are two worthwhile mentions in terms of new positions that they opened. They are both companies, so individual companies that they opened. The first one that I think is worth mentioning is EXAS, ticker symbol EXAS. They are Exact Sciences Corporation. As you can probably guess it, they do something with science, they do something with healthcare. And you would be absolutely right. What they do is they are in the healthcare space. And why can you see that this is not really moving, especially since the 20th of November? This chart hasn't been moving. It went up from about 70-ish, 69-ish till 100, and now it sits still. The reason behind that is an acquisition, because Abbott Laboratories now seems that they are going to acquire this company for $105 per share. Now, this was a great trade for Soros Investment Fund because they bought it around 73-ish before the acquisition and the merger was announced. So they are in massive profits. They realized about 30-ish% within just a couple of months. And the next one that I think is worthwhile mentioning is New Gold. And that company is probably, you can also guess it, New Gold is quite similar to Newmont. They are a mining company. They've got two mines in Canada. They've got one which is mining silver and gold, and the other one is mainly for gold and copper. So actually, Soros Fund Management and Bridgewater Associates both betting that silver, gold, and copper prices will continue to rise in the upcoming months and probably in the upcoming years. Finally, let's take a look at the portfolio of ARK Investment Management, that is Cathie Wood's portfolio. She became famous for making billions with Tesla after 2020, and now she's considered to be a classy, high-risk tech investor. I think the biggest change you can see in ARK Investment's portfolio and their method how they invest is that, let's say that we look at a year ago, you can see that the biggest companies that they had was 11% of the portfolio, 6.5, 6-ish, 5-ish, 5-ish. Now, if you look at, you can see that it's 8.5-ish, 4, 4, 3.8, 3.8. So what you can see is that Cathie Wood is spreading out the whole portfolio. So she's buying more and more companies in less and less volume. Now, because of that, you can see that these companies, the biggest ones, were actually declining in terms of their share and the share of their portfolio, of the whole portfolio. So they are probably not selling these ones because she wants to realize profits from these. Maybe there's one side of the story there, but the other side is that she needs to have enough cash to be able to buy new positions, plus to be able to increase the positions in the companies that she was buying in really small and tiny ones. I think that is the first one that we need to understand with ARK Investment Management, and I think that this trend is about to continue in the next 2, 3, or even 4 quarters. Now, the next one that I think is really important to understand is a company called Circa, because what you can see is that they have been increasing this for quite a while. In the last quarter, they increased the total share of that by almost 40%. And if you look at the last quarter, I mean the quarter obviously before this one, and you look at Circle as well, so the same company, what you can see is that they increased just a tiny bit. But if we go back one more quarter, so the quarter ending on the 30th of June 2025, this was a new company back then. Now, if you're not familiar with Circa, what they do is they are the ones that are issuing USDC and EURC, so stable coins. They are the only ones in the world that are regulated. You probably heard about USDT. Yes, they are the largest ones, but they are unregulated in terms of the US and EU regulators. So USDC is the only stable coin that is regulated in the developed markets. What that means is that it gets even more and more accepted in the traditional financial markets, and more people start using these ones. And the reason why it's really important to know about this one, because now crypto and traditional financial markets are not two different paths. They are the same path, and they are getting merged, and actually they are getting merged and merged even more as the time goes on. So Cathie Wood is definitely betting on Circle and USDC and stablecoins. So the whole blockchain ecosystem and stablecoins, that they will be a massive and important pillar of the whole financial structure and financial infrastructure in the future. And now let's mention the only company that I think is worth mentioning was a new company in Cathie Wood's portfolio, which is, it is 0.1-ish, 0.12% of the whole portfolio that she bought in, and that is the new company called WRD, which is a company called WeRide. You probably heard about this company. Maybe you haven't heard about this particular company, but if I'm telling you Waymo, Uber, Tesla, what's the common ground between these companies? Among these companies is that they are all autonomous driving companies. They are all robotaxi companies. And WeRide is just one of them. They've got contract with Uber as well. And they are now launching robotaxi and autonomous mobility services in Abu Dhabi. Then they will do it in Dubai, and they will do it in other Emirates as well, and probably they will do it in Saudi Arabia. So all around the Middle East, this is their goal. Plus they also got their driverless permit in Switzerland back in November 2025, so they are also coming into Europe. So these are the reasons why Cathie Wood thinks that this might be a great company, and she definitely wants to get in and definitely wants to take some shares before the company starts booming, because the share is down massively in the last year. It is down by almost 60%. There were definitely some exciting developments in the last quarter too, and I think it's always exciting to peek into the playground of the big players. So if you'd like to see more videos like this, subscribe to the channel and don't forget to hit that like button. See you next time.